This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And Joe, you had some interesting comments this week, as you always do. But in particular, we're not going to focus on stocks this week because the difference from the beginning of the week to the end was about 21 basis points. The big news, though, was for the first time in a couple of years, interest rates have turned positive. What's going on?
Yeah, specifically, real interest rates turned positive. That's the big deal here. The tips here, the 10-year tips is one I follow pretty closely. 10-year tips yield did turn positive last week, up to 26 basis points, which is, doesn't sound very high, and it's not, but it's a heck of a lot better than -1, which is where it was before. We had a very rapid move up in the tips yield over the last month or so. Look, positive real rates is a positive thing for the economy. It is a positive indication about the future. Now, 26 basis points is not a very positive indication about the future, but it is positive. So it's a big change. I mean, look, we've been negative real rates for quite a long time, since really January of 2020, except for a brief period during the pre-COVID or COVID onset meltdown when it, strangely enough, tips yields went positive. I'm not sure exactly why. But they did. I mean, there were so many crazy things going on during the month of March of 2020 that people were just selling everything. And I think tips got caught up in that. But anyway, it is the first time we've been positive since January of 2020. And I think it's a pretty big deal.
Well, higher real rates generally mean higher investment in the economy, which for most people is a good thing. But there are some economists, and the Fed in particular, that don't think that's such a good deal. How come?
Well, it's not so much that they don't think that the investment is a good deal. It's that they think that the Fed in particular believes that they need to cut real rates. They need real rates to be low to induce that investment. But history says that's just not what happens. And in fact, I think it makes a lot of sense why it doesn't happen. If you just go back and look at history, real rates were negative through most of or big parts of the 70s. And they were high and positive during the 80s. Well, I mean, I can't think of two more contrasting type decades. I mean, the 70s was awful, was marked by low investment. The 80s was obviously a lot better and marked by high investment. And I think it's pretty obvious that real rates being a positive number is something that does induce investment. It's not that low real rates that the Fed thinks needs to happen in order to induce investment. What happens when you have low real rates, that people are worried about their purchasing power because it usually comes during these inflationary times. And so what they do is they invest, quote unquote, in things that are not productive. They invest to try to maintain their purchasing power. So they buy commodities, they buy gold, they buy tips. Now, back then in the 70s, you couldn't buy tips. It didn't exist in the United States, but they put money in things that are not productive. When real rates are high, on the other hand, what people tend to do is invest in the real economy because they're not worried about their purchasing power. Because now you're in a situation where you may not be in deflation or even in disinflation, but you don't have high inflation. So people aren't concerned about their purchasing power. And that's a big deal. And so getting real rates to a positive level, I think is good. But look, this investment that happens when real rates are high or rising, it doesn't happen all at once. It doesn't happen overnight. And even if it did, the effect of those things takes time. But it is a step in the right direction.
Well, there have been a lot of discussion over the last several months about the potential for inflation. So now then that we're seeing real rates go up, does that put a little damper on inflation for now?
Well, I'm not sure it really puts a damper on inflation itself. It may, and that's one of those things that we don't really know about, but until after the fact. But I think what it does say, if you think about it, if tips yields are going up, that means people are selling tips. So if inflation is really the concern, why would people be selling things that protect them from inflation? I think that what it says is that people's concern about inflation is starting to wane a little bit. Now, look, why exactly that's happening is hard to say, but it is. Maybe it's faith in the Fed. Maybe they think, well, the Fed's going to do all this stuff. They're going to put us in recession, and that's going to knock inflation down. I don't know what other people are thinking. I can just only observe what they're doing. And what they're doing says that they're not that concerned about inflation, or they wouldn't be selling these tips.
Joe, you said in the article this week that put all of this together, and there are two big implications for investors. What are they?
Well, the first one I think is that value stocks are probably going to continue to outperform. High real rates are not going to be real positive for growth stocks. That's just something that makes some sense, I think. I mean, when you have negative real rates, you can take people tend to take more risk trying to get some return, and so they buy these growth stocks. But I think value stocks are going to continue to outperform, and that's one effect, and that's fine. I think the bigger issue here, the bigger potential, the bigger potential thing for investors is what I referred to in the title of the piece, which is called fat pitch. Look, if people are selling inflation protection, I think inflation itself is probably going to peak pretty soon. Inflation expectations are going to start to come down. And we've seen this in the past when real rates go positive, inflation expectations do tend to fall. And so if we start to see inflation expectations come down, the fat pitch is going to be in the bond market. This bond market, I actually saw a headline, The Intelligent Investor by Zweig in the Wall Street Journal. The title this week is Worst Bear Market Since 1842. Like, the bond market has just been killed this year. And so if you get anything that makes inflation expectations pull back in any way, you're going to get a big rally in bonds. And so we're sitting right now about 315 this morning. We got up to 320 this morning on the 10-year. Currently, when we came on, it was about 315. I think you could take that down to 250 or so, which is somewhere. We were down at 250 just at the end of March. It's not that long ago. That's a pretty good rise. A rise in bond prices of falling yields. I think you could be looking at a 5 to 10% gain in intermediate to longer term bonds. If, on the other hand, you could come down even more, if inflation expectations really get reeled in, you could be looking at something in the low twos on the 10-year, say 2.1, 2.2, then you're probably looking at close to a 20% gain in the longest duration type bonds. Now, look, I'm not saying that we're necessarily going to go out and buy TLT or some other really long duration bond ETF. We will extend duration at some point. We already did that once, and we were obviously a little bit early. We did it when the 10-year was around just about 290, 295. We went from the short-term duration bonds that we had been owning to intermediate term, and we will eventually go from intermediate to long-term to capture that fat pitch, to hit that fat pitch. Look, I think that's a big deal, because I think what's really hurt people this year is not so much the stock side of their portfolio, which, look, if you owned a bunch of growth stocks, you really got hit hard. But even if you owned the S&P 500, it hasn't been that bad. It's just a correction. And if you happen to own value stocks or dividend stocks are up for the year. So, I mean, that stock part of the portfolio hasn't done badly. The interest sensitive portions of the portfolio, real estate and bonds, have been killed, though. And so if you get something that suddenly that part of your portfolio starts to work, you can recover whatever losses you're sitting on right now. You can probably recover them pretty quickly, as long as you take advantage of that fat pitch.